Welcome to Forex School Uganda. I am Godfrey. Today we're going to look at the DAX and the trades that we took yesterday. We want to look at what was happening in the market, the analysis that we did yesterday. Now, the link is in the description of the analysis video that I posted yesterday, but we want to look at what opportunities were there for us to take in the market yesterday on the DAX 40. Now, the DAX 40 is sometimes known as the German 40. It's a German stock exchange index, just like any other indices such as the Nasdaq 100, the US 30 or the Dow Jones, the FTSE for the UK, that's the FTSE 100, the S&P, and many more other indices. But now, specifically, yesterday I was analyzing the DAX 40 or the German 40, and we did a thorough breakdown and marked out areas that we were expecting price to make turns, and we said we would drop into the lower time frames and target time those early shifts and turns before they happen. So in this video, I want to look at the different ways that you could have taken advantage of it using different trading methodologies, whether you're a break and retest trader, trading breakout, whether you want that trades based on support and resistance areas, or you are a smart money concepts trader, or you are one that trades candlestick patterns. Whichever kind of trader that you are, want to look at the different ways that you could have taken advantage of the analysis that we did yesterday to have some trades in the market yesterday and hopefully make some money before the close of the day. Let's go to the charts. So today we're doing a recap of the analysis that we had yesterday. I want to show you how exactly you could have taken these trades in the DAX 40 or the German 40, which is a German stock exchange index. Now, for you to be able to follow better, because I'm not going to do the analysis again, you could go to the DAX video that I did yesterday that was titled Scalping and Day Trading the DAX 40. So you can go check it out for the full analysis that I did yesterday before you can come back to this current video to see how you could have taken advantage of the analysis and executed your trades on the DAX 40, especially for the scalpers and day traders. Now, looking at this, because you could have traded it with three different methods. Now, there are some methods that I don't use. Of course, I'm not an SMC trader or ICT trader, though I know the concepts. Of course, I studied up quite extensively about the different trading strategies, especially with SMC and ICT. And when I tried out for the longest, I realized I wasn't making consistent money, and so I had to leave it. But at least I have a little bit of idea about the SMC thing. They call it the smart money concepts, but the truth is it's not necessarily smart. Most of the guys that are actually trading this, they talk over trading like banks. Fact is, they are actually retail traders. They're not in any way trading like banks. If you want to know how banks trade like, bro, it's quite different. It's quite different. Don't be fooled. So looking at this was the daily time frame, and we saw that price had moved impulsively to the downside, and we were anticipating a correction to come and retest this resistance area to complete the impulse and correction move in the market. That was the daily. We also saw the 4-hour as one that had formed the W formation and moved impulsively. Then it came down, retracing to retest this neckline, thereby completing the W formation. And in the process, this was an impulsive move and a correction that had been formed in the market, and we were anticipating after the retest of this neckline here, we were anticipating another impulsive move to the upside. All these details are in the video that I did yesterday. Kindly check it out. I've left the link in the description to help give you the entire breakdown of the analysis. If you follow yesterday's analysis, what was now remaining was basically execution, and now you had to drop down to the lower time frames to see how best you could take advantage of the early shifts and time your entries perfectly. So we're going to look at the different ways you could have executed. Now we know that this is the area that we are targeting on the daily, but now what we have here is price had formed this area of support that it had dropped to the downside to retest and was bouncing off, and so you were anticipating a move to the upside to complete the impulse correction and impulse move in the market. So we are going to look at the different trading styles that you could have used to take advantage of the price movement. So we'll drop to the lower time frames. Let's go to the 15 minutes time frame. Now, if you're an SMC trader, what we see on the 15 minutes time frame is that price was moving in a downtrend, making a series of lower highs and lower lows. But now after we saw price break above this previous lower high to create a new higher high, thereby changing the character of the market. So we see a change of character in the market, which really is the use of bombastic terms to make it seem like one has a mastery over the markets. What they're doing is the real deal. These are trading like the bankers, they're smart money trading. No. This change of character that some refer to as a joke and all kinds of terms, it's really a change of market structure. It's really a change of market structure from a downtrending market to an uptrending market structure, and the timing of it at the earliest. Joke. Well, not trying to make fun of it, but reality is simplicity is the key to success. All these complicated things will make your trading so complicated for nothing. Trading ought to be simple. I didn't say easy, but it ought to be simple. And so what this did was it left behind this gap here that the SMC traders like to refer to as the fair value gap. Now, if you played this out slowly to see how it would have played out, and now what you do is you're looking at this fair value gap, and looking just below it, there's no other gap that was there for you to really look at. So this was the only gap that we had, and so if you're placing your trade within this gap here, maybe at the high of the gap, and you're looking at limiting your stop loss to this low here, the low of this candle here. Let's say that's where we are limiting our stop loss. And so right here, this pink part is representative of the risk that we are taking for this trade, and this green part is representative of the profits we are targeting. And if you look at it, it's able to play out. We will have made a 3.34 reward from the risk that we would have taken. So that means that for every dollar you're risking, you're targeting $3. For every $100 you're risking, you are targeting $300. For every $1,000 you are risking, you're targeting $3,300. So let's play it out and see how it would have played out for those that traded it using the SMC style. So we are not yet triggered into that trade. Right there now. With this candle here, our trade has been triggered, and so we are in a buy position in the market. Let's play it out and see how it panned out. Price was moving to the upside. Wow, that was a great move. But then comes this drop. Now, this drop could have easily scared some out of the trade. That's why psychological and emotional training is very important. People somehow disregard psychology when it comes to trading the market. But I can tell you, trading and market psychology can be 70% of the success that you will have in trading, and only 30% could be a part of fundamentals, technicals, as well as sentimental analysis. But the biggest contributor to your trading success is the emotional bit of trading. It is the psychological aspect of trading. It is how you combat the aspects of fear and greed that will lead ultimately to your trading success. So came close to our stop loss, but not really that close. So we are still in the trade right there. So that's how the trade panned out for those that like to trade fair value gaps, or those that like to refer to themselves as smart money traders. That is how it would have played out for if you had traded it on the 15 minutes time frame. Now, if you had taken it on the 30 minutes time frame, it would have even been clearer for those that regard themselves as SMC traders. So we are still targeting this daily resistance area where we are expecting this correction to come up to after the previous impulsive move to the downside. So on the 30 minutes, here it would have been even more clear, having this as the order block, and now we see price moving away from it, breaking above this area here to change the market structure, or to have a change of character from this previous lower lows and lower highs to now a creation of a new higher high, which changed the character of the market, which is really changing the structure of the market. And what we see is that there was a fair value gap here, but there was even a lower fair value gap here. And so now the fact that this would have given us a better entry with a smaller risk, we consider this lower one. And so what we do is we could have placed our entry at the beginning of the fair value gap, and our stop loss would have been at the low of this candle, or maybe the order block, whichever is preferable to you. Now I hope I'm having them right. I'm not an SMC trader, so if you know better than I do as far as the smart money concepts are concerned, don't bash me. It's all about making money. These are terms and jargons. Don't make money. Styles do make money. It's all about the skill, not the technical jargon. So if I'm having them wrong, you understand. So now we play this out as we are waiting, because we would have set our buy limit order at this area here, at the fair value gap here, believing that price would come right there. So we have now been triggered into the trade after price came to fill this fair value gap, and now we are looking to raid this price into this daily high that we had already marked out. So let's play this out. Again, we see price retrace to the downside, but it didn't quite reach our stop out area. Again, I want to emphasize the need for psychological training for you to be able to handle these movements of price, so that whichever scenario happens to you in the market, your mind is already fortified, you're emotionally strong enough to handle such behaviors of price as you await your targets to be hit and your trading plan to be fulfilled, to play out to the later. Right there. So that is how you would have traded it on the 30 minutes time frame using the SMC trading style. So we'll look at a different style that you could have traded this as well, but with this you would have made a 3-to-1 reward for your risk taken. So let's look at another trading style. So we are back to the daily. And once again, we are still maintaining our resistance area in place on the daily that we are looking at price returning to, retracing to. And so now dropping to the 1 hour. For those that like trading candlestick patterns, this is the way that you could have traded it. Now, of course, we see on the 1 hour, there was this move to the downside, where price was making lower highs and lower lows, here we see a change of character, where price changes market structure to now higher highs as opposed to the previous lower highs. And so now we would be waiting for price to come and test this area here. I'm talking of those that trade candlestick patterns. That's different candlestick formations. We are talking of formations such as pin bars, engulfing bars, and such like. So we want to see, if you are such a trader, how you would have taken advantage of the analysis and taken a trade here. So now price retraces, and right here we see it touches this support area, and after touching the support area, you see it wasn't enough for price to touch the support area alone, because price could have continued and dropped to the downside, in which case it would have been a continuation of the previous downtrend. But now, after the retest of this support area, we see a close on the support area, and this close is not just an ordinary close, but rather an engulfing bar formed of support after a breakout and retest. And so this would have confirmed to us that indeed support is holding, the bullish volume is coming in, and that's the reason why it was able to engulf the previous bearish candle after this long rejection week to the downside, which indicates to us that the bears have lost their steam and the bulls are driving price so fast, so strongly to the upside, that they caused this strong rejection week to form, and hence the candle closing as a bullish engulfing candle. And so now, with that confirmed, you could have taken a trade at the break of the high with your stop loss at the low of this swing, and the target would still have remained at this daily resistance for a 2.3 risk reward. So let's play this out and see how it played out. We were triggered in the trade already. We had a slight drawdown, but then price returned to the blue area. Right there. Now, this came ever so close to taking us out, but that didn't happen. And so, with the holding of the trade, you would have fetched a good 2.3 reward for the risk that you took. So that's how you could have traded it as a trader of candlestick patterns. So we are going to look at the last way that you could have taken advantage of these bulls in the market and timed the early shifts. How else you could have traded it using a different methodology. So once again, we are back to the daily time frame, and so this same area remains as our target, the daily resistance area. And now what we are going to look at is those that like trading support and resistance, or basically let's call it breakouts or break and retests, and how they could have taken advantage of the price movements and made money in the market yesterday. What we see is that price had broken above this support area right here. So after a breakout to the upside, you would have waited for a retracement, which was actually happening, and now you're looking for price to retrace to this area and give you entry reason for you to be able to take buy trades to the upside into this daily resistance area. So let's play this out. So right there, price tested the support area. After a breakout, we had this retest of the support area, and we see that price rejected this support area, bouncing off so strongly. However, it's still, notwithstanding this rejection, it still closed bearish. Now, once it closed bearish, it means that there are still bears in the market that could still drive price to the downside. So it's not yet time for you to take that trade yet. Now, what you do need is a confirmation that these bears have their volume taken out, their momentum is gone, and now the bulls are coming in so strongly. But now we want a confirmation that this support area is still holding, and that we are likely to see bullish moves. Now, how do we confirm that? Well, you could call this a secret, but really, it's not a secret. It's just a common understanding of the market. It's just a simple concept. Trading is not supposed to be complicated. There's a difference between simplicity and easiness. I'm not talking about easiness because trading the markets is not easy. I'm talking about simplicity because trading the market is simple, but not easy. And now, what we need to see is price bounce off and close with a bullish close. That will confirm to us that this support area is not only holding price to the upside, but the bulls have now come in and they have now actually started driving price to the upside. That would be the confirmation we would need to have us take trades targeting this resistance area on the upside. And so let's play this out and see right there. So that was the close that we needed. It was a confirmation to us that price is not only rejecting this area, but rather also that the volume for the bulls have come in to drive price to the upside. Now, that was the time to strike. However, you do not strike immediately because you do not know. There's a reason why this candle still much as it closed bullish, it still closed with a wick on the top. That means there was a bearish pressure, however small it might have been, that stopped this price from continuing to the upside, but instead drove it down to below its high, and it closed almost close to the same place it opened. And besides, when you look at the body candle size, you realize it's a small body. So there's really not so much that you can read from there as far as bullish momentum is concerned. So what you needed to do was to see price break the high of this candle, and that is when you would be executing the trade. So what you do is you set a buy stop. I hope you understand the difference between a buy stop and a buy limit. Now, a buy limit would have been if, let's say, if price is above the area that you would want to have your entry taken. Let's say you intend to take a buy position from here, but price is still above it now. In that case, you would place a buy limit at this point here. But if it's a buy stop, for a case of a buy stop, price is below the area at which you would want to buy. And so the stop order that you set here would be a buy stop order, in the sense that once price is moving in your anticipated direction, and it gets to the exact level that you would want to be taking that trade at, as price is coming from the downside, it reaches your price level that you have set out, triggers your entry, and off you fly with price to the upside. Now, if you had traded this way, you would only have had a 1.2 reward scenario for the risk taken. Let's play this out and see how it worked out. So, price triggered our entry right there. Here it first came down. We were in a deep drawdown, but then it returned to the upside. Now this came extremely close to taking us out. Now, if I could zoom in this way, remember our stop loss is set at the bottom, at the low of this bearish candle. We place it at the bottom of the swing. Now, you do not necessarily have to place it at the bottom of the swing, but you place it 1 or 2 pips below the bottom of the swing. But in this case, even if you hadn't given it that wiggle room to maneuver, you would still have been safe, as price never reached the low of this swing. Let's play this out and see how it panned out. right there. So whichever way you could have traded it, you would have made money. Whether you are a smart money concepts trader, or you are a candle patterns trader, or you are a break and retest trader, you would still have made money. I took quite a number of positions in the market on this instrument. I think I took about 6 positions, but at different areas. Of course, I took this position right here, but then there are other positions that I took in the lower time frames for the early shifts. The position I took on the 4-hour was not necessarily a scalp trade, but more of a day trade. But as for the scalps, I took some much earlier, getting in and out at different intervals, trying to take advantage of the price move to the upside. And yeah, it was really a great day, and I hope you too had a great day. Leave comments in the comment section to let me know how you would want me to be of help in your trading journey, and how best I could be of help coming every once in a while on the channel. And if you're new to the channel, kindly subscribe, leave a like as well, as I continue to bring you more educational content. Thanks for watching. Remember to subscribe, like and share the video, and you could also check out forexschooluganda.com for more valuable educational articles and content. I will see you again.